Welcome to the weekly update, where I'll go over the action in the market for the week of August 4th through the 8th, and we'll see how things look for the week of August 11th through the 15th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, had an up week. We pretty much erased the losses that we saw a week ago and gained even a little bit more back. So we're looking fairly positive right now. Now, if you watch any of the daily videos, we're seeing a lot of negative divergences right now. And it's really the mega caps that are driving things higher at this time. We're a little bit concerned about that. We're also in a period of time, August and September during post-election years, which is what we're in, can typically be weak. We started to watch for this about halfway through July. Didn't happen. And so far, as we start to go in deeper to the month of August, it's not happening yet either. Now, that doesn't mean we always go down. It just means that we have a tendency to go down at this time. Pretty light as far as the economic reports that came out, but the market's being thrown lots of earnings information, lots of information coming out of the White House about the trade deals and tariffs and things like that. And so far, those things have been taken as positive. So the market likes that. And we ended up going up. We were able to set the high pretty much on Friday, but we have a pretty big week coming up. We're going to get CPI, PPI, and retail sales as the week unfolds, and maybe that will shift something either more positive or more negative. Okay, so going back over the week session, for the week that should be up, and I don't want to start the video again. We were up 2.43%, and we were above average with volume. For being the dog days of summer, we're actually seeing pretty healthy volume. The one thing that's a little bit of a concern, when we finally broke to the upside on Friday, we did that on below average volume. That's a concern. But on the weekly charts, we're still above average overall. Okay, and as far as the technicals, we're looking positive. There's some things to be concerned about, and I'll go through the charts here in a moment. We did go up a little bit with interest rates, so the 10-year yield is rising. Earnings seem to be quite positive, as I said, and I've got a few posts to go through there. We got a little bit of Fed speak and a little bit of Fed news that's going on right now. Okay, as far as our trend, we're in a weakening non-trend right now. First of all, we're weakening because we're below the moving average. We're not trending on the weekly charts because we're below 20. Now, does that mean we're getting set up for something to change? If a new change does develop, is it going to be negative? We don't know that yet. We can just be ready for it and watch the charts as things unfold. It's still positive for right now because the green line is still above the red line. All right, so for the week, the Dow was up 1.3%. And the NASDAQ was up 3.9%, with the S&P being up 2.4%, and small caps were up 2.4%. Now, this is week over week, because when I go through the different charts, the percentages are going to look different here, because I just go through the 5 trading days. So stocks gained this week. They were lifted by persistent buy-the-dip mentality. You still have folks out there that anytime there's some weakness, they come right in and they start buying. This might be individual investors. It could be hedge funds. They just think, okay, this is a good time to buy. I'm going to jump back in. We do have pretty good earnings as far as what's being reported and how the market is feeling about earnings. And then renewed leadership from mega cap stocks. That's what really drives the indexes higher. Apple really stood out this week. It benefited from some news. It was up 8.4% for the week, and they announced a $100 billion increase. They're already doing $500 billion into capital investment here, and that really drove things higher. And the Philadelphia Fed Semiconductor Index excuse me, sorry, I'm getting that confused. This is one of the indexes that we follow for semiconductors. It was up a little bit, only 0.8%. Earlier in the week, there was some excitement that President Trump made an announcement that chip makers who are committed to domestic production would be exempt from the upcoming 100% tariffs. That was stronger earlier in the week, and it helped NVIDIA throughout the week, but it kind of wore off as the week played out. Then the 10-year yield did rise to 4.29%. We're still under that 4.5% level, so that's when we start to get more nervous. And then St. Louis Fed President Musallam, I think that's how you say the name, a current FOMC voter who's been more hawkish lately. He said that inflation pressures may persist due to tariffs and that it appears appropriate for the Fed to maintain its current policy rate. Okay, that just means higher for longer. But at the end, he added that he remains open-minded. Now, you have a few folks that are on the FOMC who they wanted to cut rates at the last meeting. And you add some more people to that, and there might actually get to the point where interest rates are going to be cut. Now, the market is already counting on that, and I'll show you the charts later on. And there were notable developments regarding President Trump's anticipated Fed nominations for the board, not only to replace the person who resigned, but the new Fed chair as well. And there's a whole list of names, but you probably haven't heard of those names before. They'll become very famous if they're ultimately put in as chairperson. And then these moves that went on with the Fed underscore ongoing uncertainty and amid a complex economic environment that's being shaped by tariffs and inflation concerns. That's the real variable right now, and we're still tending to take things more positive as these deals and tariffs are coming out. Then we had a lot of earnings, and there was higher tariff rates on several key trading partners, and a tentative summit scheduled between Trump and Putin. They haven't announced where. The last time I looked, they haven't even announced when. It's just like, okay, these two guys are going to get together. There's no word on whether Zelensky is going to be included in that, the president of Ukraine. Reports that U.S. Customs may begin imposing a 39% tariff on certain gold bars. That shook the gold market for a while, but then the White House came out and said, nah, we're going to do an executive order to make sure that doesn't happen, and those will be exempt. All right, then I show this every week just to tell you and show you that the way things are now, the dark blue line, with inflation tending to be lower. Now, it hasn't really gone down to the 2% level that the Fed would like it to, but it's still at lower levels historically and coming down from where it was back in 2022. But it doesn't mean it's always going to stay that way. We could go up into a real high inflationary environment like we did in the mid to late 70s. We just want to keep that in the back of our minds. And we're above the 4.02% with the 10-year yield. That's when it starts biting into corporate profits. We're still above that. Now, profits are good. Earnings have been solid, but they're not as solid as they were first projected to be, and they probably are not as strong as they would be if we were under that 4.02% level. All right, this will only be updated when we get the next employment report beginning in September. So there's nothing to update here. This is the long-term unemployed, 27 weeks or over. And then this also is only updated once a month or so. That's still looking pretty solid. I don't have any IsabelNet blog charts. Apparently, the person who updates it, when I get ready to do the weekly video, they're either on vacation or took the day off or forgot. So I don't have any charts to show you there. There were a number of posts because this is when FactSet, they're kind of in full gear right now with earnings season. It says analysts increasing earnings per share estimates slightly for S&P 500 companies for the third quarter. So they're bumping these up just a little bit here. You can see this over on the side, but these are just estimates right now. And you can see the accompanying different time frames that they look at here and how this number has changed. And then the market is punishing negative earnings when the earnings reports come out and they don't beat estimates, and they're hitting them more than average. And kind of the takeaway is over here on the right-hand side. they get hit pretty hard. It's bad enough when you see buy the rumor, sell the news, and a stock price gets pumped up and the earnings come out and they're really solid and the stock just tanks, even though it was a great report and they're looking good off into the future. It's even worse when they don't meet their expectations. All right, then the update here, as of August 8th, Friday, 90% of S&P 500 companies have reported their earnings now. And of those 90%, 81% have reported actual earnings per share above estimates. That's where we're getting this positive bounce from here. When you take it all together in aggregate, companies are reporting earnings that are 8.4% above estimates. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, then here is the chart, the intraday chart that I follow. This is a 10-minute candlestick chart where it was a little bit scary on Thursday when we actually gapped up and we set the high right at the open and then spent the day coming down. Now, there was a little bit of a bounce going into the close, but then we had some positive things developing. We had a higher open here on below average volume. And then we were able to get up to this R1 level, and which was Thursday's high. But then instead of hitting this and going down, we actually broke a little bit above R1. Didn't go too far above it, but then it became support, and we closed up above R1 in Friday's session. So for the week, and this is just the 5 trading days, that's where you'll see some differences in the percentages here, where we had the NASDAQ 100, and S&P doing the best, where the mid caps, they're underperforming right now. The small caps are actually doing a little bit better than the mid caps. And then going back to the beginning of the year, all of the indexes are positive. We're coming down a little bit with the mid caps, and we're still negative with the small caps. The different sectors, we had discretionary doing the best. And that's good. That's a growth area. We like that. We also have tech doing well. But at the same time, we have staples doing well. That's a defensive area. Communication ended up being up. But then the other defensive areas, real estate, healthcare, and energy, they were actually down on the week. And we look at the scooter score over on the right-hand side. The higher the number, the better looking that particular sector, with tech in the low 90s, and that's looking pretty solid right now. But not too far behind it are the utilities at 80.4. And I like to explain this. That's typically a defensive area. But you could also make a case that utilities are a growth area because of the huge change in technology where they're going to need electricity for the electric vehicles, for AI. They already need a lot of electricity for all the crypto mining that goes on. And so there's this huge, massive increase in the need. So does that mean it's now more of a growth area at the same time? And then we drop down a little bit here. And then the weaker areas are materials, real estate, energy, and healthcare. Especially the bottom 3, real estate, energy, and healthcare. They tend to be more defensive. All right, and this goes back through just the 5 trading days where we had staples doing pretty good here, and then discretionary. Okay, now we do a ratio between these two, and we want discretionary to be outperforming staples, which it is on our chart, but this didn't really help the ratio over the past week. And then you have tech here, and all of the other sectors ended up being down in the way that they're measured here. Going back to the beginning of the year, we still have utilities looking strong, industrials, that's more economic based on what the economy's doing. And then tech also is pretty strong, followed by communication. And these 2 areas, tech and communication, are more growth areas. And then healthcare is down. That's the most. It's been getting hit pretty hard. And discretionary, which we would like to do better, it hasn't performed all that well in 2025. A lot of green here, especially with the big stocks. See where Apple was up 13.33%, Nvidia was up over 5%, Microsoft ended up being down a little bit. Then you have Google up 6.5%, Meta up over 2.5%. These are the big growth stocks. Then Amazon and Tesla, those are in the discretionary sector, so that helped that area as well. And if you hear a cat in the background, I apologize. He adds his commentary to the video here. Then we look at the relative rotation graph and look at this like if you remember back to your geometry days where you had an x-axis that goes from left to right and a y-axis that goes up and down. The top right-hand corner, the green area, these are the sectors that have been performing the best over the last year. XLK, that's tech. And we're seeing a bit of a pullback now with industrials and communication, which is another growth area. And then we saw the discretionary, it was improving and now it's starting to roll over a bit. And we're seeing more of the defensive areas here actually showing some weakness. And this presents it in a little different way with tech still looking the best. More neutral right now would be communication and industrials. And then all these red areas here are the ones that are showing some weakness. With discretionary, it had been improving, but now it's starting to pull back. And we look at the different indexes. We have the NASDAQ 100, that's growth, and that's leading. And that's when the market does the best, when the NASDAQ 100 is doing the best. We also have the S&P 100, which is outperforming the S&P 500, which still is right around this middle area here. Where now utilities have been strong here, but they have been showing some longer term weakness. The mid caps are showing some weakness, the Dow Jones Composite, and we're seeing some improvement from the small caps and the transports now. But this isn't just the last week. This goes over the last year to get a bigger picture look. And this presents it in a different way with the bigger stocks, the S&P 100 and NASDAQ 100. They're doing the best, and that's in a good solid market where the S&P is more neutral right now. Then you have mid caps, the composite, and utilities, which have been showing some relative weakness. The transports and small caps are improving, but we need to see more follow through, especially with the small caps and the transports. That would really help the market if they could continue to do better as well. Sentiment, we did tick up. We were right in the middle a week ago. We were at 50, and we were right on the border between positive and neutral. I say this is positive. They call it greed. Okay, but we did come in and we saw a lot of the improvement actually in Friday's session where it bounced up to 59. And this shows it. We were actually leaning a little bit more negative. We go with the context. We were up over 75, and that's when we look at, okay, maybe sentiment is getting too extreme. And then it started to drop, and it kind of settled down here in the 50 range, 50 plus range. But then it bounced up in Friday's session. So that's showing some improvement. Now, the active asset managers or name here, they're getting kind of extreme again. So when they get above this red line, that's a pretty extreme reading, and that we use this when it's above the red line as a contrarian indicator. Now, it could still go higher than where it's at now. We just want to be aware of this. This also shows where it came in at 96.25, higher reading than what we've seen, but not really breaking out to the upside. If it goes over 100, then that's when it really starts to get extreme. We are dropping with the VIX. We're coming down below 20. When we had the big down day a week ago Friday, we went above 20 with the VIX. Well, we were able to drop now into a different range that is showing less fear in the market, both with the line chart as well as the bar chart. Now, this is the other thing. I want to just make you aware of this, that in August and September, we typically can see the VIX going up, and that will often mean that stocks are going down. That just means fear is starting to increase and there's more hedging going on. And so when the VIX is low, it's time to go. When the VIX is high, it's time to buy, because usually we're bottoming out at that point. But this is a little bit of a concern. We don't just say, oh, well, I just go with this and I'm a contrarian all the way. We use this like another sentiment gauge. We follow it as long as it's positive and still until it starts to turn. And then when we get to really high readings, and we can use that with other charts to say, okay, what's the overall condition of the market right now? Or does it look like we're bottoming? All right, and we're still looking really good here. We look at cash to the tech sector. Black line is going down. That means the tech sector is outperforming. Also, still getting a pretty high reading with the RIDEX bear bull ratio. When it's a low reading like that, they're more bullish than bearish. And we did see a bit of a drop off with individual investors. We had been slightly above zero. We actually dropped below zero in the latest survey. We're still below the moving average with the Ulcer Index. We're still getting a fairly non-fearful reading with the spread between risky and not as risky bonds. This is an inverted version of that chart I just showed. We were coming down a little bit. That means that fear was starting to increase, but then we bounced back up a little bit in Friday's session. Still going down, but possibly bottoming here. When we look at the VIX and then a 3-month average of the VIX and do a ratio, the context here is we've been declining and that's been positive. If this continues to go down, that will continue to be positive. And we're also continuing to decline here with our long-term equity put call ratio. It's a 253-day simple moving average, and that's falling and that's more positive. On the daily side, I follow a 5-day chart and a 10-day chart, and we're getting mixed signals right now. Okay, so then this is the weekly economic index. Still looking pretty good here. Not seeing anything too crazy. Still below the black line with the Chicago Financial Conditions Index. The latest estimates from GDP now, according to the Atlanta Fed, they're coming in above 2% right now. About 2.25. You might say 2.5, maybe, up here with the latest reading, where the consensus has it anywhere from about 1.5% to the upside to down maybe 0.5% or so to the downside. Then this looks at it now because we had that negative quarter for the first quarter. Well, so far it looks like the second and third quarter are going to be positive, but there's still a lot of third quarter left to unfold. Then the New York staff, they're coming out with 2.2% right now. They do a nowcast, which quite often it contradicts what we see from the Atlanta Fed. And then this was updated a week ago when the employment report came out. We're below the red line. That's positive. Also, this is a little bit of a concern. We saw this spiking up in the latest reading with the smooth U.S. recession probabilities. Now, this wasn't updated this week. This was updated a week ago. But if we get up to the red line, that's when we get quite concerned. And then this is only updated once a quarter here. But the last reading that we had is this was coming down, and that's positive. All right, then we are going to get CPI and PPI this week. So at least the CPI numbers will adjust, but they haven't really been moving all that much. And now the market, this is what I meant when I said the market's counting on a rate cut at the September meeting. It's an 88.9% chance, 89%, that rates are going to be 25 basis points or 1/4% lower after that meeting. And the market's becoming more convinced of that because the dark blue, that's the reading right now. We have a day ago, a week ago, a month ago. The market's getting more locked into that. Now, what really played into that was the weaker than expected employment report that we received a week ago. And the market's pretty much convinced that the Fed's going to have to come in and cut rates. Then we look out at the next meeting for October 29th, a little bit of a lean that there's going to be even another 1/4% after that meeting. But there's a lot of time here for this to change. And the market's getting a little more convinced of that because what the Fed's been telegraphing is that they're looking at 2 rate cuts between now and the end of the year. Well, we're kind of going to start running out a year. And if they're going to do their rate cuts, they're running out of meetings where they can do this. Now, as a side note, the Fed can come in and raise or lower rates anytime. They don't have to do it at the meeting. They really do that just for things to stay more under control. But just be aware, like when 9/11 happened, they came out and cut interest rates a full percent. The markets were closed for a week, but it didn't have any impact. But they came out, they had an emergency meeting, and they went ahead and cut rates. So they're not held to just making their announcements at their meetings. Then here is the Fed balance sheet, which continues to decline here. And we're still going up on the year-over-year basis as they're adding some assets to their balance sheet. Not seeing anything all that crazy with the overnight reverse repurchase agreements here. We look for some kind of a big move, and we're not really seeing that right now. All right, so looking at the advanced decline line weekly chart, still above advancing moving averages, both based on price and volume. So that's still positive there. We're still coming down, though, when we look at the weekly chart of the new highs minus the new lows and take a 4-week moving average and then a 10-week moving average. That's showing some internal weakness. And we're picking that up also on the daily side. We're not seeing a real expansion of the new highs. We're not seeing much of an expansion of the new lows. We're just seeing less new highs, and that's kind of what we're seeing right here. We're still above the midpoint and going up with the short and intermediate term advanced decline ratio. All right, then this is our trend. We've dropped below 20 with the ADX. That means we're not trending. We're also in a weakening trend because we're below the moving average. but we're still positive because the green line is above the red line, but the green line's coming down. In the Arun, this measures buyers and sellers, buyers in green, sellers in red, coming off of a pretty high reading here. But when you compare the two, the oscillator is still above zero and going up. That's positive. And we're still positive on the daily side. Now, the farther we get away from this, the less relevant it is. But right at the beginning of July, or you could say the end of May or June or something, kind of a while ago now, this actually triggered a reversal signal. Well, to this point, that hasn't happened yet. And so the more we get away from when it fell below the red dashed line, the less relevant it becomes. But we still want to keep an eye on that. Then here's the daily chart. We're still looking pretty good here. And I've been trying to point this out in the daily videos. We're still seeing higher highs and higher lows after we had the big down day on Friday. We held at this pivot point and we've been coming back above that ever since then. On the daily side, we're also in an uptrend. But in Friday's session, we did drop below average, where we spent most of the week above average with volume. Still looking pretty good here. The 50-period simple moving average, that's 50 weeks. Price is above the moving average, and the moving average, which is in red, that continues to go up. The moving average crossover, that is still positive. We didn't set a new all-time high on Friday. We got close. The NASDAQ and NASDAQ 100 did, but the S&P did not. But it's very close to an all-time high. And then we want to watch this overhead level, and I've been pointing this out in the daily videos also. This is at the 64.68 level. You might want to make note of that. If we start to go up, we're still below this R1 pivot point, and the 64.68, that's where this is calculated for right now. And sometimes these longer term pivot points end up being a big deal. So just be aware of that one. And we're also getting at the high end of the range here with the trend channel. This could actually be acting as overhead resistance for the S&P. Then we look at our smart money indicators. Still looking positive here with accumulation distribution. Now this is a weekly chart. I mainly follow a daily chart. And then the boom indicator also is quite positive, but going above this red line, it could be getting rather extreme, meaning that we're getting kind of far away from the moving average and has a tendency to come back. Then chicken money flow, we're negative on the daily side. We are still positive here on the weekly side. And we're turning back and looking a little more positive, but we're above this green line with the chicken oscillator. We're also positive on the daily side. And the vortex, after getting extreme, it's been coming down, but it's still positive. And the red line's been coming up. And this is something that I've been trying to point out. At the beginning of July, we had an extreme positive reading and an extreme negative reading at the same time. So that it hasn't really changed anything. Here we are into August and nothing has really switched, but this is just something we're keeping an eye on. We're still positive with the force index. We're bouncing up after being extreme with the McClellan oscillator. So we actually came down, but we're above zero based on price and volume. So we did see a little bit of weakness here, but we're still above zero, so it's positive overall. And we're seeing this on the daily side too. The bullish percent index, those are the point and figure buy or sell signals that are being generated in the S&P. They're actually declining. And we're seeing it here and we're seeing it on the daily chart as well. It's still positive until we drop below 50. But I also put a moving average on here. And even with the bounce on Friday, we're still below the moving average. And now the swollen trading oscillator, it was positive on the daily side every day. And it's actually looking positive here. We're crossing above zero based on price and volume. And then we look at the momentum oscillators. We're negative across the board on the daily side, where we're positive here with the PMO. And we did decline, but we're above zero based on price. We also declined, but we're above zero based on volume. This is a little bit of a concern. We're seeing some negative divergences here. As the S&P has been going up, we're seeing a drop-off here in the PMOs that are rising. We're also seeing a drop-off in the buy signals, and we're dropping off with the PMOs that are above zero. We're seeing pretty much that same thing on the daily side. Now, at least in Friday's session, it was a few stocks that really drove the index higher. And if that continues, okay, then we just kind of tuck these negative divergences back, but we want to be aware of them at the same time. And we're above the midpoint with the percent B indicator here. So that's looking positive, and we did not close above the upper Bollinger Band. Here's all the momentum oscillators. All of them are positive. We're on the daily side. All of them are negative. We're rolling over a little bit here, but we're still positive with the Copic curve. We're negative on the daily side as well. Coming down after being extreme here with the money flow, but that's still positive. And we're starting to get extreme. This is showing longer term momentum with the Stochk RSI. And then the Williams percent R. So these are confirming each other. They're both showing good shorter term momentum. The ultimate oscillator, it had become extreme. It fell back a little bit. Now it's starting to go back up. That's also positive. And the RSI, and we're seeing this on the daily side. The short and intermediate term RSI, they're above 50. Here on the weekly chart, we're also above 50 and going up. And that's showing good, solid upward momentum on all different time frames. And we had the up week, so we're above zero with the 1 week rate of change. And the 50 week, after it had been declining, it did tick back up in the latest reading. The weekly special K chart, we still remain positive. We're getting very close with the daily special K chart. We're just a little bit below the red line. And I usually don't show that in the daily videos. If we do cross above that, I'll show that for a few days. And then here, we're just haven't set a new high yet, but we're still looking pretty positive here with the Fibonacci retracements and our moving averages. So we're looking good here with the Heikin Ashi. We're also looking good after Friday on the daily side here. So this is positive. We're also positive with the Kigi chart, the Renko chart, and the 3-line break chart. And we didn't have enough of an upward move to draw in any new X's this week, either on the daily side or here on the weekly side. But this is still showing the breakout that was generated on June 2nd, a double top breakout. And we're still hanging on to those gains, at least for now. We're above zero with the ease of movement, but we are declining. It's been coming down a little bit lately, and we're just barely above zero now on the daily side. So the longer term momentum, still looking positive. After dropping, we're leveling out with the intermediate term, and we're turning back to positive here with the short term momentum. So we are still neutral, though, with the Elder's Impulse system on the weekly chart. We're still positive. We're negative still on the daily parabolic SAR. So these are not necessarily confirming each other. We're negative in the short term with the mid caps. Everything else is positive across all the time frames. And bonds are still positive in the short and intermediate term based on price. Commodities have now switched to short-term negative. The dollar continues to be negative on all time frames. It fell back below its 50-day moving average. It tried to get back above it on Friday. And the dollar decline, that can be credited for why stocks are going up. The stock market likes a weaker dollar. Okay, then just looking at the different indexes, we're not quite back to an all-time high with the S&P, lagging behind as we have been seeing for quite a while now with the mid caps as well as the small caps. The Dow is in an uptrend, not too far from an all-time high, but not quite there yet. And the NASDAQ did set a new all-time high this past week and in an uptrend. NASDAQ 100 setting an all-time high. Mid caps just starting to generate a golden cross here. We did see a golden cross on the daily side about a week ago, and now it's being confirmed by what we're seeing. But they're falling behind. They're not performing as well as some of the larger caps. And we still have a ways to go with the small caps. Now, there's two indexes that I follow on the daily side. There's the S&P 600, that's S&P, and then there's the Russell 2000 small caps. The Russell 2000 small caps have generated a daily golden cross. We're not seeing it on the S&P 600 daily chart or here on the weekly chart either. NYSE, not at an all-time high here, but still in an uptrend. All stocks doing pretty good. That's U.S. and international stocks together. The FANG index setting a new closing high. These are the big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia. The Wilshire not setting an all-time high yet, but still in an uptrend. That's a daily chart. ARK, it was up over 5% this week, and it's in an uptrend. Then the banks. Now, we're a little bit concerned because on the daily side, there's a ratio between the financial sector and the S&P 500. And we have been seeing that go down, 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 down. We saw a death cross with that ratio, and we're below the 200-day moving average with the ratio. That's a bit of a concern. Is that giving us some kind of early warning to what's happening? But here we look at the bank index. We're above 50 with the RSI. The bars are still looking fairly healthy here, and we're still in an uptrend, but rolling over a bit with the longer term MACD. All right, then seasonality. This just goes back to 2021, and we've been up 60% of the time with we've been unchanged as far as the percentage. Now, we still have a lot of August left to go, so this could change either for better or worse here. And then looking at traditional Dow theory, we're not quite back to the all-time high with the Dow. We did see an improvement this week after the transports got hit, but utilities are just coming on strong here. And I already explained how they typically have been defensive, but you could also make them into a growth area now. And then commodities still in an uptrend, but they did pull back, falling a little bit underneath their 50-week moving average. And oil is getting back down into the mid to lower 60s now. That's pulling back a bit. Now, copper is still in an uptrend here. And I have another chart that I'll be going through in the intermarket analysis chart. This pullback, and we look at a copper to gold ratio, that's now giving us kind of a warning sign as far as the economy. And copper pulling back is more negative. We wanted that to keep going up. And the dollar continues to be going down. It did fall down here below its 13-week moving average. Gold, not really moving. It has up days, it has down days, but overall, you go back to about the beginning of April, it's pretty much been range bound. And then silver is still in an uptrend too. It's been moving a little bit more lately. And then we look at bonds based on price. They're still in an uptrend here on the weekly side. The monthly chart so far, this won't be completed until we finish August, but this is showing that stocks are outperforming bonds longer term. And then we have the daily maturities here, which had been falling. Now they did come up over the last couple of trading sessions. And this is the weekly chart where we're seeing rates actually coming down a little bit in Japan, pretty much flat in Germany, where US and UK rates tend to be a little bit higher. And some relative studies, this is the intermarket analysis chart. You can see going back to the beginning of May, maybe even somewhat into April, gold is still holding on to the gains and is still the best performing asset. But if you didn't get in earlier in the year, you've been kind of frustrated because it really hasn't gone anywhere since then. And then in second place, we have stocks. Then we have commodities, which are purple, bonds based on price, that's blue, oil, which is now negative year to date, and then the dollar, which has been the least best performing asset, actually negative year to date for 2025. Now, this is where we're seeing some strength coming back in, at least for right now. The NASDAQ 100 is outperforming the S&P. Now, the S&P is close to an all-time high, and the NASDAQ 100 set an all-time high, but the NASDAQ 100 actually outperforming, that shows growth is outperforming. And then the S&P 100 really shot up here compared to the rest of the S&P 500. Growth breaking out, still looking really solid when we do a ratio longer term with value. And gold, it's been going nowhere. Stocks have been going up, so we saw a bit of a decline with that ratio. And then the dollar, which has been going down, and then gold, which was really outperforming earlier on. Now they're just kind of leveling out right now. And then bonds continue to underperform stocks longer term. And low volatility to S&P ratio, this is continuing to go down. That's positive. That means there's more pro-growth. When we really spiked up, this is when we were going down in March and into April earlier in the year. Discretionary, it'd be nice if this was doing better, but it's still in an uptrend longer term when compared to staples. Energy is really underperforming the tech sector on all of our charts that we see right now. And the small caps continue to underperform the tech sector. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So some long-term looks at the breadth thrust here. Not really anything new being triggered. The one thing that I had been pointing out is when we really took a thrust up here in June, we've been making lower highs here. Now that you could possibly make that as a negative divergence, but so far to this point, it really hasn't played out to mean all that much. And we did improve with the Zohorchak method. We were at a full -10. We've actually rebounded up to a -6. Now that's still negative, but it is showing some improvement. And then longer term, still well above this trend line going back to the 1987 crash. That's also showing the same chart, but shorter term. And we're still looking okay here. We're coming down just a little bit with the 50-period exponential moving average of the new highs, new lows for the S&P, but we're still above zero in the bigger picture. Also coming down a little bit, but still above zero with the NYSE new highs minus the new lows, and then taking a 50-period exponential moving average of that. And then the NASDAQ weekly chart, I've been bringing this up quite a bit in the daily videos. We're still hitting just a little bit above this trend line going back to 2009. This is still looking good though. NASDAQ 100 growth versus the Dow value. That ratio still continues to go up. And we look at the NASDAQ 100 again as represented by the QQQs and the small caps. This ratio continues to go up as well. We're still leveling off and actually declining a little bit here with the 3-month yield. And we're still trying to go up here with the new highs, new lows for the NASDAQ, the cumulative measure there. Then we look at seasonality. Now, the first half of August, we're right here where the red arrow is. Going back to 1950, we are positive, but this is where we really start to see better performance. The second half of August typically does perform better. Then this is the NDR chart, just showing how we're kind of matching up here. This is about a week old now, but when you look at this chart, about in August, about now is when we start to top out and then see some weakness that could go through into the latter part of October and possibly even a little bit into November. And then this is post-election years, which is what we're in, how we have not performed well going back to 1950 in August. So August, you go back to 1964, only up 56% of the time with a return of 0.1%. Then we take June through November, which that's the time frame we're in now. We're generally up 3.4%, but a little over 2/3 of the time. And then this also shows post-election years. They've been very strong lately, so this is actually looking a little bit better. If you go back to just 1985, we've had better performance, but if you go all the way back to 1950, they tend to underperform. And then this is also the weakest part. This is put out by Stock Traders Almanac. The weakest rally usually comes in the summer. Well, tell that to 2025. So far, it hasn't really been happening. And then we just look at post-election years going back to 1950, where we do tend to be down. We're up 8 out of 18 times. We're down 10 out of 18 times with a negative return of 1.2%. Then at some point, I'll be able to drop these next few charts out of here, but this is when we tend to see things really trail off a little bit. But so far, we really haven't been doing that. And we tend to see volume down. Now, we were below average in July, but so far in August, except for Friday's session, we've been above average with volume. And we also dropped below average with volume during the month of August with the NASDAQ as well. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.